Hi, everybody. It's Danielle Damianov. I'm with CMG Financial, and I'm here to talk to you about the All-in-One program. So you've probably seen an ad or have more interest on the All-in-One program, and I want to take 10 minutes and just show you what it does and a little bit more about it. We do have an in-depth webinar, so if you want more information or there's things that I did not cover, please take the more in-depth webinar. It's taught by the leaders in my company who are amazing and have been doing this for years. So a little bit about myself. My name is Danielle Damianov. I'm the area manager with CMG Financial. My contact information is below. My email is right there, and there's my cell phone. I have 20 years in the mortgage business. I joined CMG in February of 2021. I right away got AIO or All-in-One certified. So I do have my All-in-One certification. I also do conventional FHA, VA, and jumbo loans, to name a few, but that's mainly my focus. And I'm licensed in Florida, Massachusetts, and California, more states to come. If you're wanting to get pre-qualified or want to do an online loan application, jot down my website. That's where the online loan applications are. It's at lendfla.com, and that's where you can get more information as well as apply online. So let's get started. I want to go through this pretty quickly so it doesn't take up too much time. So what is the all-in-one loan and what is an offset mortgage? So the all-in-one loan is a type of an offset mortgage, okay? And an offset mortgage is a type of home loan that's going to blend a traditional mortgage with one or more deposit accounts held by the same financial institution. And in this case, it's going to be a checking account, and I'll explain in a little bit how it's all going to work. But the savings balance in that account that's maintained in the deposit account is then used to offset the mortgage balance by lowering interest payments that are due. I know it's a little confusing, and it's not something that you hear about a lot in the United States, but I can promise you that it is not a mortgage that nobody's ever heard of. And we'll go through that in just a second. But essentially what it is it's a first mortgage line of credit. So a lot of you know the term line of credit, you know what that is. This is going to be like a line of credit. It's not exactly like a line of credit, but it does have line of credit features, and it's going to be combined with a checking account. So when you get this mortgage, you want to make sure that your line of credit or your mortgage combined with the checking account, that checking account is going to be your main checking account that you use for direct deposits, for writing your checks every month and things like that. This mortgage is going to allow you to tap into your equity whenever you need it, okay, without having to refinance. And that's one of the things that I absolutely love about this mortgage. They want you to stay in this mortgage for the long haul. It's a 30-year mortgage. So in traditional mortgages, and we'll talk about this in a second as well, but in a traditional mortgage, when you make your mortgage payment every month, and we all know that for the first 7 years, more money is going towards interest than it is going to principal. So it's not like you have a ton of equity in the beginning with a traditional type of mortgage, but all of the equity that you do have, you're not able to tap into. You either need to refinance your mortgage or take out a line of credit and have two mortgages in order to access that equity. So this mortgage is also going to save you thousands of dollars in interest payments over the life of the loan. It's going to use your idle cash to pay down the balance of your loan every single month or every time you deposit money into that account. And it's going to allow you to use the money to make more money, to be able to either invest in things like real estate, invest in the stock market, invest in other things that is going to increase your net worth, or allow you to do things like use the money for retirement or pay for your kids' school or go on a world-class, worldwide tour, whatever you want to do. You can use that equity at any time. time. And honestly, that is one of the things that I absolutely love about this mortgage. So an offset mortgage is a new concept in the United States, but it's not a new concept worldwide. In the US, a lot of commercial lending uses that sweep account, and it is similar to a commercial type of mortgage. In Canada, in Western Europe, in Australia, in New Zealand, there's a lot of countries, especially in the UK, that have these types of mortgages. So it's not a new mortgage, so to speak, but it is probably new for you if you have not heard of it before. So what is the problem with a conventional loan? And I will tell you, this loan is not for everybody. There are going to be certain cases and instances where this is not going to be a good mortgage for somebody. If you spend every single penny that you make every single month, this is not the mortgage for you, because it's not going to do anything for you and could probably hurt you in the long run. Okay. This is going to be for people that are cash flow positive, that do not spend every penny that they make, that have money left over every month, and that money just sits in a checking account and does not do anything. So if you look at a conventional mortgage, the money is only flowing in, it's not flowing out. So you have to remortgage if you want to access that equity. If you want to access the equity in a conventional loan, like I said, you have to either do a cash out refinance or take out a line of credit in order to tap into that equity. With this mortgage, you can use the equity at any time. So in a conventional mortgage, the other problem is that the majority of your money is going towards interest. So here is just an example of an amortization schedule and what you're actually paying every single month. And you can see for the first 12 years of the loan, 12 months of the loan, the principal and the interest, look at the difference in that monthly payment. Right? And then if we go down towards the end of the loan, we can see that a lot more is going towards principal and a lot less is going towards interest, but it takes a long time to get there. And in this mortgage, you're actually paying principal first. So how does that work? Let's look at the offset mortgage. So you're going to have your mortgage on your home and you're going to get a checking account. Okay. That checking account, you're going to deposit all of your checks into, okay? And it's going to be a mortgage combined with a checking account. So when you have money in your account, that money is earning low amounts of interest, right? That money in that account, what it's doing with this offset mortgage is you're taking the money that's sitting in that account and it automatically pays down the balance on your mortgage, okay? So it's going to offset the balance in which interest is charged on the mortgage. And usually mortgages are high amounts of interest. Your interest rate might not be that high, but it doesn't mean that you're not paying a lot of money in interest payments. Okay. So if we look at an $800,000 mortgage and you have $100,000 in the bank, that $100,000 is going to offset that mortgage balance and lower your principal to $700,000. So I will give you an example. For me, my husband and I do real estate investing. So we will invest in real estate and we might have to use money and have hardly anything in our savings because we're using it to flip a house. But when that money, once we flip the home, it goes back into that account. So as a real estate investor, when that money is coming back into that checking account, you're putting it back into your line of credit. That's going to lower that principal balance by that amount of money that's in here. And it will be able to be used at any time, ultimately lowering the interest that you're paying because you're only paying interest on whatever the principal balance is of the loan. So you have 30 years to access that equity, where most line of credits are not on a 30-year draw. You're also going to get with this checking account an ATM card, checks, bill pay, ATM card. You can use the ATM. You can do direct deposits at any time. So you're going to be able to use this account as if it was a regular bank. And any of the money that sits in that account is going to offset the principal balance because every single night it sweeps. So how it works is your deposits, when you get a direct deposit, you get your check and you deposit that into your checking account here. Okay, let's just say it's $14,000. That $14,000 is automatically going to go over and pay down the mortgage. And then every single night it's going to sweep, and the interest that is owed will be tallied on that day. So the interest is calculated daily, okay? So money that's not spent from this account, that idle money that you have, is always being used to lower the principal balance, which is overall going to lower the amount of interest that you're actually paying on the loan. So what makes it different? It gives you so much more flexibility than what a conventional loan gives you. It's going to save you tens of thousands of dollars in excessive mortgage interest. Okay. It is going to allow you to build equity in the home 2 to 4 times faster than a traditional loan. Sometimes you can pay off the mortgage in half the time without paying without making one more mortgage payment or any more money out of your pocket. And the simulator will show you how that actually works. Pay off your mortgage in half the time or less without changing your budget. Access the home equity dollars freely for 30 years without ever having to refinance. The goal is to keep you in this mortgage for as long as you own this home, okay? Because you're going to be able to use the equity in your home at any time and do the things that you want to do or invest in the things that you want to invest without having the restrictions of having to refinance. So we'll stop the endless and costly cycle of refinancing whenever cash is needed. And we all know in the state of Florida that refinancing is extremely expensive. Okay, so if you refinance into this mortgage, you're not going to have to refinance again. And then it's going to allow you to pay just the interest only whenever is needed. Okay, so if, for God forbid, something happens, you're only paying the interest because every time you deposit money into that account, you're automatically paying down the principal balance. Well, what happens if you lose your job for 3 months, let's just say, okay? And you don't make a mortgage payment because you don't have any money coming in. Well, assuming you're not right at that balance, you took out an $800,000 loan and that balance is $800,000. Assuming you're not there, let's say you're an $800,000 loan and a $750,000 balance, right? Well, every month that you don't make that mortgage payment, the only thing that's happening is that interest every month is just adding up, okay? And it will go and add up until it hits the $800,000 mark. You're not going to be marked late on your credit report. There are no late payments. The interest is just going to accrue. So if, God forbid, something happens and puts you in a tight spot and you can't make the payments for a couple of months, that's okay, as long as you have enough equity in the within that mortgage. So this is an innovative mortgage. We're changing the way we think about mortgages, and we're changing the way that we think about money. And so if you think about it, a lot of times people will say, when I ask them what matters most when borrowing money, is it the interest rate on your loan, because we all know that rates are low right now, or is it the amount of interest that you pay on your loan? And the answer is that it's the amount of interest you pay on your loan. Because if you are paying 2.75% or 3% interest, but over the life of the loan that equals $200,000, or you're paying 4% interest and over the life of the loan you're only paying $120,000 in interest, the amount of interest you pay matters most, right? So the all-in-one is 100% the smarter way to borrow. It's engineered to help people avoid a significant portion of their interest that's charged over the life of the loan and eliminate their housing debt rapidly and more comfortably. You're not changing anything that you do on a monthly basis, and you're still able to pay that loan off, and a lot of times, in half the time, without changing a single thing in your spending. So we're going to talk about the allowances and the features. It's available for both a new home purchase and a refinance up to $2 million. You have to have 10% down. So if you're buying up to $1.5 million, you need that 10% down payment. There will be mortgage insurance on anything over an 80% loan to value. So it is in your best interest to put 20% down or have a 20% equity stake. We can do a primary residence, second home, or investment property. 20 to 30 days after closing, that's when you're going to receive your ATM and Visa credit cards. Okay. You can have authorized users on those accounts. You're going to set up your online bill pay. You'll have your account and routing numbers, your mobile banking app to be able to download. You can get checks. So these are all of the features. You'll have the bill pay, you'll have wire ability, you'll have the ATM and credit card. So you're basically using a credit card with your home equity. It's freaking amazing, in my opinion. Direct deposit, you're direct depositing your checks into those accounts. You'll have personal checks, and there is an annual fee of $60 that will begin the start of the second year. Okay, so the account is fully accessible through any mobile device. Statements are sent and available on the first of each month. And when you close with us, you're going to have a specialized customer service rep that will, number one, explain the entire process to you. And then number two, it will allow you to ask them any questions that you have that I might not be able to answer. So if we look at the line of credit structure of the all-in-one, there's no balloon payment. And a lot of times with a line of credits will have a balloon payment, meaning after a certain amount of time, you have to pay off that full balance. There's no forward amortizing repayment schedule. It is a 30-year draw. So we're talking about a 30-year mortgage on your home, or like a 30-year line of credit that you can draw on and use for 30 years. So let's say you pay off within year 5, your balance down to zero. Okay. So you have a $400,000 loan example, and you pay that balance down to zero. And now your kids are going to college, and you are like, oh my gosh, I have to pay $60,000 for, their college this year. You can pay the $60,000 out of the mortgage and then work, however much the next year and pay it off, or maybe you don't. And the next year it becomes 120, and you do that for all 4 years of school. This gives you the flexibility to do whatever you want within for 30 years. Okay. So this is just kind of going through an example of how it works, and how the line of credit structure is. When it comes to interest rates, there's 3 different options. It is based off of the 1-month LIBOR. It's a 1-month adjustable option. There's a 3-year fixed option and a 5-year fixed option. The index is the LIBOR, as I mentioned. The margins range between 2.5 to 3.75, and the floor is at 3.75. So because the LIBOR today is very low, the rates are going to be around 3.75. Okay, the lifetime cap is going to be whatever your fully indexed interest rate is from the beginning, plus 6%. So let's just say it could go all the way up to 9.75, if not higher. Even if we look at mortgages in the 5 to 6.5% interest rate range, with the all-in-one I'm talking about, and we compare that to a mortgage, and we'll look at the all-in-one simulator, but compare it to a mortgage where you're only earning 3.5, you're usually going to still pay off your mortgage in record time and never pay any additional mortgage payments. Okay, because it's all about how much interest you're actually paying instead of being about how low your actual interest rate is. So if you have a starting balance of $800,000, you deposit your paycheck of $14,470. Your new balance on that mortgage is now $785. So you are only paying $785, your interest on $785,000. Okay. That cash becomes equity that you use now to pay your bills. So maybe you pay Comcast, maybe you pay your kids' school, maybe you pay your car payment. Everything comes out of the equity account. So when you use the equity, okay, first of all, the balance is going to change every day. So as you pay the bills, that $785,000 balance may go up to, $787, depending on what you're paying. So the interest is charged daily, and this is just an example using a 5.2% interest rate. It's calculated every night on the unpaid principal balance. So the all-in-one interest is calculated differently than with other mortgages. It gives you enormous control. The interest is calculated daily. And so that day's interest would be $114. Now let's say so at 800,000, it's 114. You make your payment, 780, you make your deposit, you have a balance of 785. And then once you made that deposit, that day's interest is 112. Okay. So it's going to change depending on what the balance is in the account. And then it's automatically going to draft out of your account the interest on the 21st day of the following month. So every day in a month, that interest is calculated depending on where your principal balance is. At the end of the month, it's all totaled up and it comes up with an actual interest payment. Remember, you're making principal balance payments every single time you deposit any money into that account. So you're not paying principal on your loan because you already are when you make those direct deposits. The interest is then taken out on the following month on the 21st of the month. So this just shows you how it would be drafted. So let's just say that 793 balance, there was 7481 in expenses. So your interest that you owe for that month is 3430. On the end of the 21st day of the second month, 3430 is going to come out of that account. What is not spent, and that's your idle cash that remains in that account, is used as equity. So if you deposit $14,000 from that example into the account, you had your expenses, that leftover money is the equity, and that keeps the balance down. Where with a traditional mortgage, it doesn't work like that. You're making your monthly payments and you're paying a lot towards interest and a little bit towards principal every month. With this mortgage, when you direct deposit into this account, you're making a big principal payment, and then you're making your interest payment on the following month. So here are the credit standards, and I'm trying to go quickly so that way I don't waste too much more of your time. You can always take the extended version of the webinar. I just wanted to briefly touch upon the highlights. So it does follow Fannie Mae credit standards. We do need a 700 credit score for owner occupied and second homes, a 720 credit score if it's an investment property. Higher than 80% loan to value, we need a 760. 10% of the line amount has to be in reserves when you take out the mortgage. We can do this on a single family residence, 2 to 4 units, so duplex, quadplex, condos, and in some cases, non-warrantable condos, which I did get one approved. So we cannot exceed 99% of the line of credit in the beginning. The qualifying payment is going to be the line of credit times the rate times 30 years times taxes and interest. You don't have to worry about that. That's a qualification thing that I have to worry about and figure out if you qualify. So if you need delay financing, there's no seasoning requirements for that. So if you paid cash on a home and you want to take this mortgage out 3 months later or 2 months later to put the money back in your pocket, you can do that. We can also pay off a second line of credit and do this as a rate and term refi. We can use your assets if you're of retirement age for qualifying income. And there's no minimum advance amount if you're looking to do a cash out refi. And if you have 20 properties that are financed, we really don't care if you're buying a primary residence. If it's a second home or investment property, no more than 10. So as I mentioned from the beginning, this is not for everybody, okay? It is for salaried employees, it's for commissioned employees, it's for self-employed earners, pre-retirees, retirees if you have good income, but the main thing is cash flow positive. You need to make sure that you have money in your account after, after you've paid all of your bills every month, or else that mortgage is never going to go down. Okay. So cash flow positive people, this is what this mortgage is for. I highly encourage you to go to aioloan.com, put me as your loan officer, Danielle Damianov. You can learn all about the mortgage there, and you can also do a simulator. So take out your mortgage statement, sit down and do the simulator, okay? Use 5.5% as an interest rate. That's not what the rates are today. They're 3.75 to 4. This is August of 2021. So who knows where they'll be, moving forward. I have no idea. So don't quote me on the rate because it's going to depend on your credit and everything else. But use 5.5 or 6% and see where you're at, okay? You know what your finances are. Plug it into the simulator and check it out. So I am not going to stick around for questions right now, but if you do have questions, you know where to find me. I am at Danielle Damianov or Danielle D at cmgfi.com and lendfla.com. You know where to find me. My cell 786-359-7976. And I hope you have a great day. I hope this answered all of the questions that you might have on the all-in-one program. Thanks so much for watching this mini webinar, and be sure to take the lengthy webinar or message me for questions if you have any that are specific to yours. If you want to apply, lendfla.com. Thanks so much and have a great day. Bye.